Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we understand that our clients are time poor and can't always get into the office during business hours. For this reason, we have released a short series of videos to assist clients by answering some of their common questions they have around running their practice and also creating private wealth. In this video, we're going to talk about common types of practices for GPs. Stephen, what are some common practices that GPs operate through?
Okay, thanks Brendan. So most doctors move through a series of stages in their work life, and the choice of structure that's going to be appropriate for them is going to vary during those stages. So initially, most will start out as an employee within the hospital system and progress through earning some private practice income. Typically at that stage they're carrying on business as a sole trader. When they move away from salaried employment, perhaps into a contracting role with someone else's practice, they can either continue as a sole trader or perhaps consider using a practice structure of some form. And that decision to switch into a practice structure can be influenced by things like tax, asset protection and also their future plans. Then when they progress, if they do, to practice ownership in its own right, then the structure would typically be either a trust or perhaps a partnership model. And the nature of those structures might change depending on how many owners are involved, whether practice premises are involved, how the profits are going to be treated as they emerge out of the structure.
So what about companies and service trusts? They're quite often talked about with GPs.
Yeah, Prosperity Health, we tend not to make a lot of use of companies in setting up practices for GPs. Companies are more complex administratively, so profits need to emerge as either salaries or dividends, both of which bring their own complexity. Loan accounts out of a company are particularly dealt with under special rules in the Tax Act, and they can be more problematic, and also there might be issues with payroll tax. In relation to service trusts or service companies, look, we might recommend those in certain circumstances, but they're typically not the model we go down. We need to be able to justify the decision to pay a management fee to a third-party structure. The ATO took a lot of joy out of the whole service trust and service structure model several years ago when they ramped down on the markups that can be paid by a practice to a service entity for expenses incurred. So we just typically find there are better ways of managing the overall structure which involve less complexity.
And when you mentioned you don't typically use companies, I assume you'd still use them as the corporate trustee from that asset protection point of view?
Absolutely. They would stand as a public face for any trust that would be operating.
So given that there's quite a few options there, how do you narrow down what's the right structure for the right GP or for that particular GP?
Yep, so it always involves a conversation. We always start with getting an understanding of the future goals and needs of the GP and making sure that the structure we're choosing is flexible enough to take those needs into account. Look, as a simplistic example, if the short-term goal of a GP was to set up a medical practice using the services of other contracting doctors and then invite those contracting doctors to come in as owners at some point in the future, then it wouldn't make sense to start that practice off inside a discretionary family trust structure because you can't give ownership rights in that kind of structure to someone else. What we typically do in that case is we might start with a unit trust structure even though there's no one else as an owner at the moment because you can give ownership rights in a unit trust. So it's always important to start with a broader understanding of where things are heading. Secondly, it's really important to understand the nature of the income that is being derived by the practice and how that might change over time. Without getting too technical, the Tax Act broadly defines three types of income. There's property income, personal services income and business income. So personal services income, which we often talk about with our GPs, that's income which is mainly derived from personal efforts or skills of an individual, whereas business income is income that arises substantially from the assets employed in a business or the staff employed in a business. And so the income is being generated off the structure of the business rather than primarily from the efforts of one individual.
And why, I guess, from a point of view, is that important to distinguish the income and the type of income or where it comes from?
Yep. No matter what structure is put in place, the Tax Act seeks to ensure that personal services income ends up in the hands of the individual who generates that income. So if I'm a GP sole trader on Friday, I can't go home over the weekend, set up a trust or company structure and start work again under that new structure on Monday and expect that suddenly all the income that I'm earning off my own efforts will be able to be diverted to my spouse or my investment company. The structure doesn't change the nature of the underlying income. Whereas if we've got business income involved, then which is being generated from the assets or the employees, then potentially that income can be allocated to either family members or investment structures, and hence that brings a much lower tax rate. So understanding the nature of that income is really important. Fortunately, the ATO has given a lot of guidance over the last 15 years and a number of rulings and guidance notes on this very issue.
So a number of rulings have been released. What are the important things, I guess, that are covered from a GP's perspective? What do those rulings cover?
Yep. So without getting too technical, probably the most important ruling to start with would be IT 2639, which is a very important ruling for medical practitioners. It really deals with this issue at its heart of whether income in a practice is personal services income or business income. So it looks at a range of factors. There's a basic rule of thumb which is part of that ruling, which says that if a practice company or a trust has at least as many non-principal practitioners as principal practitioners, then the income being derived is considered to be business income. So unpack that a bit. The devil's always in the detail. If there are more non-owners than owners producing material fee income for the practice, then this rule of thumb would say the income is going to be business income. So if you're in a position within your practice to satisfy those tests, you'd be far better off operating via a trust, some kind of structure where you're able to stream income out more broadly than if you were practicing as a solo trader. That's probably why our advice to our GP clients is pretty much always the best place to invest first of all is on your own practice. If you can migrate from being in the position where you're an employee to earning personal services income and then on to earning business income by running your own practice, you're going to be able to access a far better tax result at the end of the day. And that'll come through being an employer of other GPs who might be contractors to you, bringing in other fee earners, perhaps practice nurses, so you can pass those kind of tests.
So assuming we are generating what's known as business income and we're operating through a trust structure, is there a bit of restriction on where that money can or that profit can be distributed? So if I had 6 kids at home or all adult kids, could I distribute all of my income evenly between them and maybe none for myself or a little bit for myself? Is that possible?
Yeah, so this is an area that the ATO is putting some particular attention to over the last few years, not only for just medical practitioners but for all professionals, accountants, lawyers, architects. They provided some guidelines in 2014 which indicated that even if a GP practice is passing all these tests and is generating business income, it's their expectation that the principal generating the income, so the GP in question, would still receive a fair and reasonable share of the income from that practice, even if it is all business income. They provided 3 benchmarks or tests that they use, and they're holding the kind of, I guess, the stick in this arrangement is that they will be looking at individuals' affairs and giving increased audit attention to any practice or GP that doesn't either meet one of these benchmark tests. So the short answer to the question is no, you can't just give all the business income within your practice to someone else. You need to still be cognizant of this overarching principle that the GP needs to receive a fair and reasonable share of the income.
So given that information, I guess what you've just talked about, is there a common structure that you find you're often recommending to a GP?
Look, so most of our GP clients would start out using a practice trust through which they operate their practice. That's either working as a independent contractor in someone else's practice or ultimately perhaps migrating to their own practice within that trust. So when they're working with in someone else's practice, they're still earning personal services income off their own efforts. So the way the system would work is that their medical practice trust would receive all the income from their activities. It'd pay all the operating expenses of the practice. It might pay a salary, a market salary to a spouse for administrative services if they're being provided. It might pay superannuation. But at the end of the day, the net profit that's left over is still being distributed out of the trust to the doctor. When they migrate to earning business income, so they might start up their own medical practice, they can still conduct that through the trust, same trust, they don't have to change the trust. But in that case, they would have a broader pool of beneficiaries that they could look to distribute income to. When it comes to multi-owner practices, then typically we'd be setting up a unit trust. That unit trust would conduct the practice, would receive all the income from the patients, would pay all the expenses, and then would be distributing the profit from the practice out to the unit holders, who typically would be family trusts under the control of each of the owner GPs. Those family trusts can then make independent decisions about what they do with their profit share compared to what the other owners are doing. Again, we're driven by what is the nature of the income that is being generated by the practice. So if that multi-owner GP practice also has a large contingent of contracting doctors, we might be in the position where the income being generated is business income, and so the underlying family trust, when they receive their profit share, could be distributing to adult children, spouses, investment companies, or the like. Again, still governed by that ATO guidance from 2014 about making sure that the GP owners are getting a fair and reasonable share of the profit.
Thanks, Stephen. Fair bit of detail in there. Obviously an area that's quite complex and might be worth watching that video again. Well, I hope you've enjoyed this episode of Prosperity Health's GP series. For more information on this video, or in fact links to other videos, please go to our website, prosperityhealth.com.au, and there you can also make contact with one of our advisors in your area. Thank you.